U.S. inflation rates have exceeded the Fed's 2% target for nearly 5 years. Yet the FOMC has cut the Fed funds rate 5 times in the past 14 months, including another cut in late October. Was that a mistake? What's the thinking? I ask an FOMC member on today's show. Welcome to Economics Applied. My name is Stephen Davis. I'm a senior fellow at the Hoover Institution, which sponsors this podcast. Joining me today is Jeff Schmid, President and CEO of the Federal Reserve Bank of Kansas City. He also sits on the Federal Open Market Committee, FOMC for short, which sets U.S. monetary policy. Welcome, Jeff. It's great to see you again.
Likewise, Steve, and it's great to be here. Thanks for the invite.
Well, thanks for being here as well. We last spoke in August at the Jackson Hole Economic Policy Symposium, which takes place at Jackson Lake Lodge, Wyoming. Surely one of the most spectacularly beautiful places on Earth. Is hosting that event the toughest part of your job?
Well, the first quick story is when I got the job, I think it was August 21st of 2023, and the board said the first thing you got to do in 3 days is go out and help host it. So that was pretty daunting because here, as you know, I'm not a professional Fed. I came from the outside, so I followed the Jackson Hole event very religiously, but to go out there and really host it, it was amazing. But after 48 years, Steve, the team's got it down really well, and it was. I think this year was one of the best ever. I was really proud of the institution and how it delivered.
Yeah, well, I enjoyed it, and I want to note that you sent me this autographed, laminated, uncirculated dollar bill in appreciation for my contributions.
You're quite welcome. Yeah,
and
I love doing that.
First, I was really excited, but then I was thinking, the dollar doesn't go as far as it used to, and maybe my contributions weren't so valuable.
Yeah. Hang on to it. It's uncirculated, so it's worth something.
It's worth something. No, seriously, it was a very nice touch, so thank you for that.
You're welcome.
So, all right. Last week in Denver, you gave a speech titled Maintaining the Balance in Monetary Policy. And you expressed the view, and I'm going to quote here, that inflation is too high, and the labor market, though cooling, remains largely in balance. And I want to first ask you, can you explain to us how you reached those two judgments, the part about inflation and the part about the labor market?
Sure, you bet. Well, so first of all, it's a real challenge, as you know, with the shutdown that's now thankfully been resolved. That the data streams that you would normally get were impaired, but there has been a lot of commentary about that impairment, and I'll make a couple comments before I go specifically into what we're seeing on the data side. I think one of maybe the geniuses of the structure of the Federal Reserve System was to create the 12 Reserve Bank system, which really allows us to kind of regionalize the things that are happening in this $30 trillion economy. And what it did do, the shutdown for us, is it actually reinforced and actually strengthened the muscle we have relative to the information flows that we get within districts. So, we've got 500,000 square miles. We cover 7 states. But we over the decades, we created this architecture of network that really starts with the board in Kansas City, but then we have respective boards in Denver, Oklahoma City, and Omaha. Those funnel up the information on what's happening in the economies in both states and communities in the region. And then we have another set of 4 advisory councils that are maybe more economic specific, be it community specific, be it agricultural, be it energy related, like the conference we had last year, and it allows you to really pull up what's happening in the 10th district. And then I think as you look at all 12 banks, you're familiar with the Beige Book. I think my sense in the last FOMC is that everybody really strengthened their network of information flow, specifically with regard to the inflation data that we get inside our districts, but also the labor data that's inside the district. So that being said, I think we worked our economists under Joe Gruber a little bit harder in this last cycle, and I think this is kind of what we found. And actually, I think you interviewed Professor Golden. A couple things that came out of Jackson Hole for me was really a new sense of macro demographics and what's happening relative to, let's say, fertility rates or migration of labor between states. Those were two of the more important papers, I think, that I've seen in a long time. But given that, my opinion at this stage is that we haven't finished the fight on the inflation front. In fact, I think there's pretty strong information that would suggest that while we seem to have gotten the inflation number down into the mid to low twos, it's really reversed itself back into I think probably the mid to low threes. The concern for me specifically about the inflation numbers is that it's actually the basket of what's going up has gotten larger. Most specifically with goods inflation. We were starting to see some improvement on the services side that was pulling that inflation number toward 2. But on the goods side, we've seen kind of a reversal. I actually have seen some goods price increases that we haven't seen, frankly, for decades, that have kind of reversed themselves. So I have a belief that inflation in its macro sense is an economic thief, and I think it's specifically a felon for the lower half of the economic and financial strata of our country. So we're into this 4 or 5 years. We've got to finish the job, and then when I look at the labor force, I see something from a macro standpoint that's, for my use, is much more structural than cyclical. So by that I mean I look at maybe 3 elements that are influencing the labor market in a big way right now. One is just demographic shift. I mean, people my age, I'm a baby boomer, we're leaving the workforce in numbers we've never seen before. I think the last number I looked at was somewhere around 4 million a year leaving the workforce through 2027. Now, that's on average over 300,000 jobs per month on average. Then you layer in the new immigration policies. That's probably influencing the number between 1 and 2 million a year.
Yeah, and that's been very abrupt. That change
very abrupt. Yeah.
Right.
And then the third thing I think that's happening that we're hearing just almost continually, I mean, everybody wants to talk about AI, but I think that there's a pausing going on inside the marketplace, especially inside, let's say, manufacturing, financial, some pretty sizable industries where they're trying to reconcile what they can operationalize on the AI side before they hire. So you kind of get into this no hire, no fire kind of pausing. But frankly, I think we see that somewhat reversing itself into the first 2 or 3 quarters of 2026. So when you put all that into the pile, while you see kind of one-offs as far as layoffs and that type of thing, that cooling effect, I'm just not seeing anything that's going to really trend our unemployment numbers up over the next few quarters in a significant way.
Okay. So I'm going to come back later to the government shutdown and the increased challenges that presented to you. You already raised it. It's an important issue, and I wanted to ask you about it. But let's stick with kind of the current monetary policy thinking. So in here, I should know, you dissented at the last meeting, right?
I did.
And so you were not in favor of a 25 basis point cut in the Fed funds rate. So just note that. So my next set of questions is partly not so much about your thinking, because my thinking and your thinking, I think, are closer than my thinking and the median FOMC member. So, but let me put a little bit more of it out there, and you can help us understand not just your own thinking, but the FOMC thinking. So I already alluded to the fact that, we've had, by the Fed's preferred measure, 19 consecutive quarters, almost 5 years, with inflation above the Fed's 2% target. And yet the FOMC has seen fit to cut the Fed funds rate by 150 basis points over the last 14 months. It kind of makes you think, what's the logic behind these decisions? And when I ask that question, there are two facts that are on my mind. The first one I just mentioned, the 19 straight quarters of above target inflation. The second one you alluded to earlier, but I'll just put as the public hates inflation. So that's just a fact.
Sure.
We've been reminded of that in rather visible ways. So why, in the face of this, has the Fed been cutting its policy rate, and by quite a bit over the past year or so?
Well, so let me reflect a little bit on maybe the 2024 cycle, because I think there was a realization that we were making pretty good progress into the last couple quarters of 24 toward the 2% mandated number. And I think we also got some interesting data on labor at that time. We had been kind of in that 3.5 to 3.6% unemployment number. It started to trend up, and it eventually kind of trended up toward about that 4 to 4.1. And I think there was action at that time to try to everybody. Well, I shouldn't say everybody. I think in my particular case, I wasn't a voting member, but I do remember that I believe that maybe the policy rate was a little on the restrictive side. And as we were starting to see maybe a little bit more action into that kind of low 4 number, it made sense to me to try to create a little bit more rebalancing into the policy rate side because of those factors. Then we kind of went into the first couple quarters of 2025, and we were seeing further improvement in the inflation numbers. But then there I think it was probably sometime in the mid to late summer that there was some trending that we were seeing on the inflation side, while we were arguably at still full employment. I mean, if you believe that the low to mid 4s is full employment, which I do believe that, then you really needed to take a strong look at where the inflation numbers were trending. And then by the time, so in the September cycle, I voted for a 25 basis point. I was part of that vote.
Okay.
I believe that was a little bit of I think the chair called it an insurance cut relative to what we were seeing in the labor market numbers pre-shutdown. So some of those numbers were somewhat compelling. And then we started digging a lot deeper into the macro side of what was happening in the labor force, and really started to get very specific with our regional contacts about what is happening in your labor pools. And that's kind of when I decided, look, I'm fine with the insurance side of the September cut. But at this stage, I think the policy rate, I'm not sure what it's restricting, Steve, at this stage. I mean, capital and credit flows seem to be pretty robust. If full employment is still in that mid to low 4s, then I think we've got to really wake up to this whole inflation number that seems to be trending on the upside. And I believe, to your point, I believe that the American public expects us to really keep rebalancing this dual mandate. And for me, the risk side is on the inflation number.
Right. And you also made the point in your speech, and I'm sure this was quite deliberate, that kind of from a financial conditions perspective, things don't look tight. Equity market valuations near all-time highs, high yield bond issuance near all-time highs, credit spreads across different bond qualities and credit qualities are small. All of this stuff suggests financial conditions are on the relatively easy side.
Yeah.
So in addition to all the things you've said, though, there's something else that would weigh in my thinking if I were in your shoes on the FOMC, which is the following. It's first thing, I don't think we have a great handle as professional economists or central bank experts on what it takes to de-anchor inflation expectations. We know that we have lots of reasons to think that there's huge benefits that flow from having firmly anchored inflation expectations near the central bank's target. We don't really understand the dynamics very well by which you achieve that or lose it. We know the way we achieved it last time was awfully expensive.
Yeah.
Back in the early 1980s.
Right. Yeah.
Well, if I was sitting in your shoes, I'd be thinking, well, you know what? The Fed had huge credibility before the pandemic struck. It lost a lot of credibility because of the 21-22 inflation surge, both because of the inflation surge itself and because the Fed was kind of slow to recognize what was really going on. And so I'd be thinking, well, you know what? Let's make sure we don't make that mistake again. I'm basically saying I see the risks as somewhat asymmetric between failing to promptly recognize when the labor market is cooling too much and failing to head off another mini inflation surge. That would make me pretty cautious on the inflation side. And does that argument not have much resonance?
No. I look. I've been at this 2.5 years now, and I'm still learning. But I do have an appreciation for Jay Powell's sense of this whole soft landing concept. So look, it's great sport to look back and say we missed an opportunity to let's say get after it faster in that 21-22 cycle. You could also go back into even the 2020 and the 2008 cycle and make this similar commentary about what we were doing and when we did it. But that said, I think the fact that we were as aggressive, raising rates over 500 basis points like we did, and then that once we saw what was happening, which I think was pretty with a lot of precedent, the whole supply cycle issue that created that surge in inflation was kind of that post-pandemic, and I don't think any of us really knew exactly what economically how things were going to play themselves out kind of post 2020. But what I think we did was and are doing is there a way, because I'm pretty sure historically, and you would be able to tell me this, is there a way to actually get us down to that 2% mandated number without breaking the economy into a recession or some other crisis? So I think we do have a credibility issue if we don't continue to try to push this number down, because there's some, while there are some positive signs when you kind of break the macro down to some micros, like for instance, we see some positive signs on rent inflation and some positive signs on the housing and some increases in supply side in certain industries. But we hear a lot on the insurance side. We hear a lot on healthcare. There's still some real stickiness in some of these inflation numbers that we just kind of have to keep fighting on a macro basis. But I think your point's well taken. I think if we believe and we use that full employment number as an anchor in that, let's say, 4 to 4.5% range, I think we got to continue to fight ourselves down to that 2% number, and that's where I believe we should be with the policy rate.
Yeah. So a few things. First, you're right that once the Fed did switch to a restrictive monetary policy stance in reaction to the 21-22 inflation, it did so quite aggressively. So, I definitely agree with that. And the point of my comment wasn't so much to criticize the Fed. I've done that on other occasions, but I won't do that. That's not my point here. My point here is simply to recognize the legacy that comes out of that is very different than the legacy that the Fed was operating with throughout the 2010s and so on. There was a very so that's the thing that I don't quite see factoring into FOMC decisions as much as I would have wanted to. And it speaks to your point about how it really is urgent to be on the path of getting back to something closer to the 2% target. because that is, for better or worse, that is what people now fix on as the sign of achieving the Fed's so-called price stability, the price stability part of its mandate.
Yeah. And by the way, I subscribe to the concept of a neutral rate. I think that makes a lot of sense. I've had speeches in the past that would argue that maybe the neutral rate in its old theoretical form might be a bit higher than we would have otherwise thought, let's say with writings on R-star and things like that. But I believe that there's an equilibrium in these things that we need to consider. The other part of it is, we're very hard anchored on the dual mandate with full employment and price stability. Then you've got kind of, the third leg that I would say would be economic growth, and how is the policy rate affecting that? I think we have to kind of keep our eye on that. That's been a little choppy, but it's been pretty robust here in the last quarter. We'll see what the fourth quarter does. But
to our earlier discussion about financial conditions, it's hard to make the case that restrictive monetary policy is impeding economic growth at this point. I think it's hard to make that case.
Yeah. The other thing that I try to do in some of these venues, Steve, is I'm a visual learner. So I talk a little bit about, there's been lots of discussion about Fed independence and the nature of what the Fed does as it relates to the other branches of government. Let me make a couple comments about equilibrium. So the way I look at this is every administration that comes in Congress really they own the engine of a train, and if I was part of that ownership group, I would want to run the train as fast as possible. I think growth does have a lot of good spin-offs for the American economy. The American people are really in the cars; they're along for the ride. But we're not the engine or the car. We're the two rails. So, keeping those rails in some balance is the way I look at my job at the Fed is, if you get 1-2 out of whack, then the train is at risk of derailing, and you don't want that to happen. So I think it's actually a good thing that we're, let's say, part of the system, but we're not the train. And what we're trying to do is just try to keep some sense of that train going as fast as it can relative to those two rails being somewhat in balance. And that's kind of the way I look at this thing when I think about inflation. Just seems to be the rail that seems to be out of balance today as we go forward into the new year.
I think that's well put. The central bank is not the engine of prosperity in the economy. That has to do with a lot of other policies, and except in the public sector, but in private sector activity. And it's possible for the central bank to mess up the railroad train. Okay.
Oh, totally. Yeah.
We know that, but
yeah.
But if you want the train to move smoothly and quickly, there's other parts of government and policy that need reform much more than anything in the central bank. So it's worth keeping that in mind, and I agree 100%.
The other thing that's a little off topic, but I had an epiphany this last 6 or 8 weeks with the shutdown is around the whole idea of independence is, throughout that whole 6 or 8 weeks, we still move $5 to $6 trillion of payments a day. And so that argues another reason that it's probably good with the Fed overseeing payments, the payment system, that there was no disruption in that flow. And that flow is important to the train, right?
Yeah, it is. You're right. Okay.
It's really the fuel.
I hadn't contemplated that argument before, but it's a subtle argument for why you want to keep the Fed somewhat independent from the rest of the government. I get it. The payment system, there's another way to, the payment system is sort of like the oil lubricant in your engine,
Totally.
It doesn't matter until it matters. And then you're really in bad shape. That messes up. So, okay, point taken about the role of the payment system, although there's many ways to design a payment system, but you definitely want your payment system to function through thick and thin, that's for sure. So let me go back to this issue about the other aspect of the shutdown that you mentioned earlier, which is some key economic indicators, statistics, and reports were not available during the shutdown, including perhaps most notably for you, the October edition of the Employment Situation Report, which is compiles statistics from the household survey and the establishment survey, the current employment statistics. And it's our chief source of information at the national level about unemployment, employment, and labor force participation, and a great deal else. So that was unavailable to you.
Yeah.
And I want to get your thinking on how much that impaired the ability of you and your Fed colleagues to assess the economy in real time. And I want to set this up carefully, give me another 20 seconds here or so. So I'm going to stipulate that the federal government statistics remain the absolute gold standard and the essential benchmark for where the economy is over time on the employment side and inflation measures and so on. Okay, let's stipulate that. So in terms of the employment side, for what I mean by that, for example, on the establishment survey, is once a year we get benchmark, where those survey data are benchmarked to comprehensive universe administrative records data set. Those are absolutely vital. There's no private sector, there's no outside the government party that could reproduce that. What's much less clear to me is whether in today's information environment, where we have many, many sources of information, you described some that flow up through the regional Federal Reserve banks, but there's many others, including in my own small way, I contribute to this through various surveys and the economic policy uncertainty indexes and so on. But there's hundreds of these things now. So it's not clear to me that the world will end if the employment situation report comes out a week or two later than it does now. So we get smaller revisions down the road, which we've learned are politically costly. It's not even clear to me that it's so important that it come out within a few weeks, as long as we get very solid gold standard numbers, because a lot of the other in-between stuff can be filled in from other sources. And I want to get your sense of, I know I'm putting you on the spot here a little bit, because you don't want to tell the BLS folks that if we don't get your data for 10 weeks instead of 4 weeks, it's okay. But how important is it really?
Well, so I'd almost love to turn that back and have you answer it, because you're a great researcher. You're steeped in the sciences of these things. But here's what I think has happened over a fairly long period of time, and I think that a lot of the reserve banks have done a nice job at this. Is look, we want and we can't wait to get the BLS pipeline back and running well. That's an element of what we need. But I think a lot of things that we do end up being kind of validations of things that we're doing on our own. Let's say, for instance, at the Kansas City Fed, we have what's called a labor markets condition index. So what we'll put, like a lot of great economists do, we'll put a lot of, I think in this case, probably 27 different factors into a basket measurement to try to figure out more of the trending. I mean, so we all know as an analyst, you've got to look at what is the level compared to what we're trying to do, and how is it trending. And I think there's a lot of really good research and indexes that have been developed over the years that actually, when you put them all together, give you a sense of what is the overall condition of the labor market. I mean, you've got 160 or 170 million people that are working at something every day in the U.S. Taken, let's say, private sector data along with public sector data and trying to figure out where is that moving. And from my standpoint, what we've done is we've gotten a little bit deeper in our own basket of numbers that we can develop in our district, and then we'll collaborate with the other 11 districts and see what they're doing, and then try to get a sense of confidence and trend line of what's happening in that macro side of that 160 million workers. And I think that at the end of the day, what BLS will drive to us will be really important data points that I think will either validate or argue against what we're thinking that labor market is doing at any given moment. And so I hope that kind of answers your question, because I think, like I said earlier, our muscle had to get better when we didn't have the BLS pipe running.
Right.
But let me make a postscript to that that I think is important. I think what I'm seeing relative to agencies like the BLS is there's a new conversation going on about are we getting the data that we want, and are we using innovative tools to get it more real time? So, are the old ways of surveying and emailing, is that the way that we should be doing it? And I'm also kind of excited about what things like artificial intelligence or other tools can do to actually modernize the data that we get in a real-time sense and try to reduce the adjustments that we end up having to suffer through as we look at these things on a hindsight basis. So I'm actually a little bit excited that there's more talk about how do we get more innovative with some of these data points.
Yeah. So a few things there. It's, I guess the way I think of it as a researcher, and I'm genuinely struggling with and thinking about the balance here, but a few things are obvious. One I already alluded to, which is that the information environment beyond what the government statistical agencies provide has exploded. And that's been especially true in the wake of the pandemic, but it had begun long before then. So this is in line with what you said is, your muscle within the Federal Reserve System at the regional banks is strengthened. That's one example, but there are many other examples out there. And so we need to rethink what's the most useful role for the public statistical agencies, given all the new sources of information outside, including some of which can be brought in through public-private partnerships. Some of this already happens, as I understand it. So the current employment statistics, you can, rather than getting survey data, you can feed in some administrative record sources, which cuts down on the survey response burden, probably cuts down on errors too once the system's in place. Those things we should continue to pursue. In the backdrop of this discussion that you and I are having, we should make it explicit. There's been an across-the-board decline in survey response rates for government surveys in the United States and really around the world. And that has presented serious challenges to the statistical agencies in the way they've traditionally collected data. So they need to look to alternative, innovative methods that rely less heavily on these traditional survey instruments. So there's definitely room here for something of a rethink in how we produce economic statistics, and a rethink of what's the right mix of public sector statistics and private sector sources. So yeah, that's ongoing, and there are reasons to be excited about that, but we do need to get on that path in a big way, in my view.
Yeah, and I think that the other side of this, as we go into the new year, kind of taking this whole AI and robotics conversation that's very active is I mean, and we're doing this at our Federal Reserve as we speak. I mean, we committed to a 10% reduction in force here a few months ago, and over the next couple of years, but what that sparked was a conversation of the turnover of our team, the demographics of our team, and is that actually an opportunity to look at AI and how we reskill our workforce into the future? So I know I go, especially in Washington, the question becomes, is AI going to replace workforce? Actually, I don't believe it is. I think it's just going to give us an opportunity to say, what are you doing that this can do? And then how can we reskill you to another place that actually leverages your brain power more? And I think that's actually happening inside the labor structures. And I think we're going to emerge the next couple of years as we move through kind of this retirement bubble that's occurring on the baby boomer side. and really going to emerge on the other side of it with really actually needing AI tools to supplement the what I would consider the new workforce post baby boomer demographic.
Yeah. And just to underscore that point, that's even more true if we continue on the kind of restrictive immigration policy
Yep.
that we have moved toward in the very last part of the Biden administration and very aggressively in the Trump administration. I mean,
Yep.
our net immigration figures now are much lower than they were for in the previous years and previous decades.
Yeah.
So
Yeah, we need to, I mean, we talk about this all the time. The Fed has gone over the last 50 years from fairly heavy operational, check clearing and cash distribution to a very intellectual business. And so for us, talent and technology is going to win the day relative to what the Fed delivers. And we're going to have to cherry pick talent from all over the globe to make that happen and to continue to be the leader, the economic leader in the world.
yeah, well, I'm very much on board with you there. That's been a recurring top theme on various episodes of this podcast: the importance of immigrants and talented people coming into the United States throughout our history. It's part of the secret sauce of our success. But I got one more topic I want to ask you about, if I may, because it'd be kind of remiss if I didn't in this current environment. I want to get your thinking of how U.S. tariff policy factors into decision-making by you and by your FOMC members.
Yeah. Well, so certainly it's a fiscal element that creates an action or reaction. And here again, I'm not an economist and I'm not a scholar. I look at this a little bit more from a practical standpoint. I'm a banker and former regulator, and I always have to kind of be careful and really think about something like a tariff in a more macro versus micro, because you can microeconomic a tariff all day long. But from a macro standpoint, for me, it really is part of a massive stew. I mean, you got a $30 trillion economy, 30% of the globe's production, and look, a tariff is going to create a behavioral action or reaction across border, and trying to actually track what that behavior is, whether it be I'm going to take a margin hit or I'm going to take a lower price or I'm going to pass it through. It's chasing ghosts in a lot of ways for me. So what I try to think about is for me, it's much more of a behavioral risk that what we'll hear from people is like, look, I'm not affected by tariffs, but I can use it as a bit of a smokescreen to raise prices. So for me, it's much more dangerous if we don't keep our eye on that more macro inflation number and the nature of where it's coming from. Like, for instance, take healthcare. I don't think healthcare in a big way is probably affected by tariffs, but there's so much inflation action still in healthcare that we got to be aware of. That I think it creates behavioral things that actually risk us de-anchoring from our 2% mission, and so it's just another element of the stew for me that you got to keep your eye on more the macro indicators that are pushing inflation upward.
Okay, so keep your eye on the ball.
Yeah, the big ball. Yeah,
the big ball.
Yeah.
Okay, so yeah, that's pretty sensible from an operational point of view. I guess the thing that I would add to what you said is there's been a lot of gyrations of tariffs under the current administration, but also nobody really knows where they're going.
Yeah,
where they're going to end up. We have a big Supreme Court decision coming up, which may, depending on how that case goes, the IEPA case, depending on how it goes, could basically, throw out most of the Trump tariffs on a revenue basis. We'll see. But this is just, the stew is like, we don't even know what's going into the stew and coming out of the stew. So And
Well, and we went, I think more the late second and then through the third quarter, we were very active traveling, and uh, the businesses that you would believe would be most affected by tariffs. You hear a lot about small, medium businesses and how they buy a lot of product from overseas, but even some really massive retailers. It seemed to me like they actually had their plan pretty much baked through this coming holiday cycle. So I think what we're going to watch really closely are some of the inflation numbers in the first and second quarter of 26, because if businesses were going to start to raise prices in any measured form, especially on the goods side, I think you might see it more in the first or second quarter of next year.
Okay.
And I'm hopeful that you don't see it. I'm hopeful that you get enough kind of supply adjustment going into the new year that maybe that they won't be so aggressive to change and raise prices. That kind of, I think that behavior might be modified relative to what we end up seeing as a GDP growth in the fourth quarter.
Okay, very good. I'll just note for our listeners that we've talked a lot about tariffs on other episodes of this podcast. We'll include links to those episodes on the webpage for this episode. So there's a lot to do there, but we've covered a lot already. So I'm going to let you get back to your real job now. And thanks so much for taking the time, Jeff. It's been a real pleasure.
Well, pleasure's mine, Steve. To all your listeners, we're approaching Thanksgiving. We're very grateful. We're a Fed that's mission focused, and we really appreciate these interactions to further our cause to try to help the American people understand what's going on. And thanks to you, they're a lot smarter today than they were last year. So thanks for all you do.
Well, thank you. That's a very gracious and wonderful note on which to end, and to the American people and so on. So
Okay,
thanks a lot, Jeff.
You bet.
Take care.
Thank you. All right, you too. Bye-bye.
Bye-bye.